Welcome back. We cut through the noise and give you the essential knowledge you need fast. Today, we're setting our sights on the Caribbean, specifically the Dominican Republic, which is emerging as a surprisingly promising yet highly complex iGaming destination for 2025. Before we jump in, it's probably good to explain where this analysis comes from. We are the Gambling Databases research team. We're a group dedicated to delivering in-depth analyses of the global iGaming landscape. So in each country report, we explore key aspects like local regulations, taxation, player experience, all of that. Our goal is really to provide a clear, data-driven look at how the gambling industry works in each market and, what makes it unique.
And that's what makes the DR so fascinating right now. When you just look at the fundamentals, the metrics are really strong. I mean, you've got robust digital infrastructure. Internet penetration is sitting consistently between 75 and 80%. And then you layer on this huge established tourism sector. So capital is already comfortable flowing through the country. Our projections show this market growing at a CAGR of 10 to 15% annually for the next 5 years. That's top-tier growth for the region.
That potential is definitely a hook, but as we found in our research, it comes with a pretty steep price tag.
Exactly. This growth didn't just happen. It's the result of very deliberate, very recent regulatory overhaul. So our mission today is to unpack how the government moved this from a gray area into a structured white market. And critically, to understand the trade-offs they built right into the system. It's structured, but the cost of admission is intentionally very high.
Okay, so let's start with that shift. Historically, gambling regulation in the DR was, like a lot of resort nations, focused almost entirely on land-based casinos, right? Catering to tourists.
Right, the legal anchor goes way, way back. Law number 351 of 1964. For decades, that was the entire framework. Purely brick-and-mortar casinos, almost always tied to the big hotels and retail sports betting.
All about the tourist experience.
Exactly. The turning point for anything digital was incredibly recent. Formal online regulation only came in March 2024 through Resolution number 136, 2024. And this resolution is the real heart of the new system. It set up explicit licenses for online casinos, for sports books, virtual gaming.
Yeah.
It finally dragged everything into the light.
So that clarity is a huge plus for any serious operator. But who's actually running the show now? And I guess who might be taking over soon? Because a shifting regulator can be a huge concern.
Yeah, that's a key point. Currently, the main body is the Directorate of Casinos and Games of Chance, the DCGA. It's under the Ministry of Finance. But as you said, things are in flux. There's a legislative proposal right now to establish a new body, the General Directorate of Games of Chance, the DGJA. The idea is to centralize everything. So it signals that while the rules are set, the actual enforcement structure is still solidifying.
And operators are getting into this market knowing they might be dealing with a whole new oversight body pretty soon. What about the licenses themselves? I remember reading something that seems designed to lock operators in.
They definitely want commitment. A license is valid for 5 years, which is good. But here's the catch. You can't transfer or sell that license during the first 3 years. That is a significant lock-in. If the market turns, you can't just sell your assets and get out quickly. It forces a long-term view.
Right. It's designed to stop speculators. What about player safety? What are the must-haves?
The compliance is extremely strict. Mandatory age verification, of course. Robust KYC and AML procedures are a given. But for responsible gambling, they mandate active tools. Things like self-exclusion systems and very visible session duration tracking.
Okay, this is where we get into the economics of it, what we've called the operator paradox. It's a white market, but the cost of entry is extremely high. So what are we talking dollar-wise?
The financial barrier is substantial. This isn't for a small player. For an online casino license, you're looking at a fee of about $346,000 US, just for the 5-year term. If you just want sports betting, it's a little less, around $260,000.
And just for context, that's a fee structure that rivals some established European markets or even major U.S. states.
Yeah.
Not what you'd expect in a developing regional economy.
Precisely. It sends a very clear message. Only serious capital should apply. And you can't rush it. The application timeline is 6 months or more because of the deep due diligence they do. It's a real test of patience.
So that's the financial side. What about the non-financial burdens, the stuff that can really trip up a modern digital-first company?
This might be the biggest hurdle of all. It's the strict local presence mandate. You cannot run this market remotely. You have to establish a legal Dominican entity, maintain a real physical office, and this is the big one. All your gaming servers and core IT have to be domestically based.
Wow. So they're forcing physical infrastructure and staff to be inside the country. Why so strict on that?
It's a policy for 2 reasons. One, local economic impact, creating jobs. And 2, control, over data and over taxation. By forcing a physical presence, they can audit you. They can ensure you're not just routing profits offshore. It's about tax oversight.
So high fees and heavy local infrastructure are the pain points. What's the reward? What's the sweetener that's supposed to make it all worthwhile?
It's the single biggest fiscal incentive. Licensed gambling companies are completely exempt from corporate income tax, a 0% rate. This is clearly designed to attract that big foreign capital by offering a very competitive long-term profit environment.
Zero corporate tax. That sounds like a dream. But the government has to get its money from somewhere, which brings us to the GGR tax.
Correct. That 0% CIT is offset by a very high tax on gross gaming revenue. The rate is set at 29% for land-based operations, and we expect a similar rate will apply online. So while your corporate entity isn't taxed, almost a third of your gross revenue goes straight to the state.
That's a huge slice off the top. But there's one more layer, one that creates what you call the player tax friction.
This is the critical warning in our report. The government imposes a mandatory 15% tax withholding on player winnings, and the threshold is pretty low. It kicks in on any winnings over 50,000 Dominican pesos, which is about $850 US.
15% is steep. But it's the operational side of that that's the real problem, isn't it?
It creates a huge headache. The licensed operator becomes a tax collector. You have to track every player's winnings, and once they cross that threshold, you're legally required to withhold 15% of their payout. So what does that do? It gives your highest value players a massive incentive to go play on an offshore black market site that, of course, isn't going to withhold anything.
So the government has basically created a rule that undermines its own regulated market's ability to keep its best customers. That's a huge risk.
Yeah.
Okay, let's shift from the operator to the customer. Who is the typical Dominican player?
You're looking at a young, very concentrated market. Population is about 11.6 million, with a median age of just 32. And it's highly urbanized. Over 85% live in cities. That really simplifies marketing and infrastructure. And digital access is all about mobile. Penetration is near 90%. So players on mobile platforms, you have great 4G coverage, 5G is expanding in the cities. The average revenue per user, or ARPU, is around $300 to $350 US a year.
That ARPU figure is interesting. What does a $300 annual spend tell us about the customer?
It tells us the market isn't driven by a few massive whales. It points to a stable middle-income customer base. They're making regular, manageable wagers. It's a mass market proposition. They are frequent bettors, but not necessarily high-volume bettors.
And given that profile, what are they actually playing?
Sports betting completely dominates. It's about 45% of all participation. And within sports, you just cannot overstate the cultural importance of baseball. Betting on the local pro leagues is huge, and of course on MLB. After that, you have slots at about 30%, and then general online casino games at 18%.
So any successful operator needs a deep understanding of local baseball, not just, global soccer leagues.
Absolutely. Local integration is everything, and that includes payments. Debit and credit cards are still king, but local bank transfers and mobile wallets are growing fast. Operators have to integrate those local methods seamlessly.
And quickly on advertising, what are the red lines there?
The rules are very location-based. You're strictly prohibited from advertising near vulnerable spots. So that means schools, healthcare facilities, places of worship, government offices, and all content must be truthful and can't target minors.
Okay, let's put all the pieces together. The high fees, the zero corporate tax, the 29% GGR, and that painful 15% player withholding. What's the bottom line assessment from the gambling databases team?
Our official rating really shows the split personality of this market. We give the operator E-score a 6.0 out of 10. That's just moderate, and it's dragged down by that huge capital investment in the local infrastructure rules.
But the demand from players is clearly there.
It is. The player access score is a stellar 9.5 out of 10. The market is fully legal, mobile access is great, and the local appetite is proven. Which brings our overall market attractiveness rating to a 7.7 out of 10. So high potential, but it is absolutely fundamentally capital intensive.
Let's get to the brass tacks then. The reality check. What's the required investment and how long until you break even?
This is essential. When you factor in licensing, legal fees, setting up the office, the servers, the initial investment required is between $600,000 and $800,000 US, maybe more. And because of that high upfront cost, the time to break in is estimated at 3 to 4 years. which is significantly longer than average.
So this is a market for scale and for patience. Who is the ideal operator for this?
The ideal entrant has deep pockets and regional experience. We're talking about existing LATAM operators, someone who is genuinely well capitalized, we'd say $2 million plus in funding, or maybe an established land-based DR casino brand that wants to go digital. And on the flip side, we'd say you should definitely avoid this market if you're a bootstrap startup. Also avoid it if your model is purely high rollers. That player tax will kill your VIP retention. Or if you're a remote-first company that's unwilling to build that physical presence.
It's a very structured market. It's clearly designed to attract serious long-term foreign investment while making sure the government gets a huge piece of the pie. So here's the final thought to leave you with. That 0% corporate tax is clearly a lure for foreign capital, right? But is that benefit enough to offset the double whammy of a high 29% GGR tax and that crippling 15% player withholding tax? Especially as the new DGJA firms up enforcement, it's a very finely balanced equation. That's all the time we have today. Thank you for joining us as we explored the opportunities and the significant costs of the Dominican Republic iGaming landscape. For the full text of this and other country reports, visit our website at gamblingdatabases.com.